Hey everyone, last night, some people didn't lose because gold betrayed them. They lost because a screen flashed one cold sentence. Margin requirement increased. In markets, that message doesn't argue with you, it removes you. And when it hits, it doesn't matter if your thesis was right, or noble, or long-term. It only asks one brutal question. Do you have cash right now? Here's what made this episode feel like a thriller. Gold dropped hard, then snapped back fast enough to make people swear the chart was glitching. Silver did the same, but louder, uglier, more violent. Safe havens aren't supposed to move like that, right? That's the story we tell ourselves. Except safe doesn't mean immune. Sometimes safe just means everyone runs to the same door. And then the door jams. So the real question isn't why did gold go down? The better question is who needed dollars so badly they were willing to dump their shelter, because that's the hidden engine behind a lot of these whiplash moves. Not sentiment, not vibes, liquidity. When the room catches fire, people don't sell what they hate, they sell what they can, and then the plot thickened right after the drop. Margin requirements got tightened on key contracts. If you're using leverage, that's not a footnote. That's the trapdoor. One day you're positioned, the next day the exchange effectively says, same bet, higher rent, pay up or reduce. And if you can't pay up fast enough, you don't choose to sell, the system sells for you. You ever stop and think how weird that is? The trade can be fundamentally correct, and you can still get erased by timing. You can be right on direction and wrong on survival. Markets don't reward correctness, they reward staying power. That's why I'm not obsessed with the headline number of the drop. I'm obsessed with the plumbing that turned a normal move into a cascading one. Let me frame it like a war room briefing. There are two clocks running at the same time. One clock is the long-term story, inflation, trust, geopolitics, central banks, the whole saga. The other clock is the short-term story, dollars, yields, margin, and forced selling. When those two clocks disagree, the short-term clock wins because it has a deadline, and the deadline is tonight. That's why safe haven can still get dragged underwater in a liquidity rush. And here's the first big reversal that catches people. The more crowded a defensive trade becomes, the more fragile it can get in the short run. A shelter with too many bodies inside becomes a stampede risk. Not because the shelter is bad, because the exits are narrow. Stability isn't always safety. Sometimes it's just the silence before the invoice arrives. Now, quick one-sentence disclaimer before we go deeper. These moves are multi-causal and messy, so I'm describing mechanisms. And incentives, not pretending there's one villain, one lever, or one simple answer. Back to the mechanism. When margin gets raised, it doesn't just affect gamblers. It affects anyone who built a position that assumes normal volatility. The rule change is subtle but savage. You need more collateral per contract, which means your buffer shrinks instantly. If you're overextended, you have two options and both taste. Like metal, option 1, wire in more cash. Option 2, cut positions into weakness, right when you least want to. That's how a price drop becomes a chain reaction instead of a single event. And that chain reaction has a rhythm. Price drops a bit. Accounts go red. Brokers call for more margin. Some people meet the call. Some people don't. Positions get liquidated. That forced selling pushes price lower. Now more accounts go red. Now more margin. Calls. It feeds on itself like a microphone too close to a speaker screeching louder. Because of the loop, not because the original sound was huge. You ever think about how the most dangerous part isn't the loss? It's the speed? A slow drawdown is painful. A fast drawdown is lethal because it collapses your options. You can plan around a storm you see on radar. You can't plan around a squall that hits between dinner and bedtime. That's why whiplash days create legends and wipeouts at the same time. And this is where silver gets its own darker subplot. Silver is thinner, more volatile, and more prone to violent air pockets. It's the same story: liquidity, leverage, forced selling, but with a higher amplification setting. When silver drops, it doesn't just fall. It lunges. That means margin pressure arrives faster, and liquidation becomes a bigger portion of the move. People love silver because it feels like gold with turbo. The problem is, turbo works in reverse too. Here's a quiet educational note I want to slip in just once because it matters. If you ever use leverage, treat margin rules like law, not suggestions. Know your broker terms, stay within local regulations, and size so a sudden requirement hike doesn't force a panic decision. Now, if you're watching this and thinking, okay, but why did it bounce? Good, that's the second twist. In a classic margin event, the market often does two acts. Act 1 is elimination. The weakest hands get knocked out, not because they're wrong, but because they're underfunded. Act 2 is the snapback. Once forced selling runs out of victims, price can rebound simply because the selling pressure evaporates. It looks like confidence returning. Sometimes it's just exhaustion. That rebound is where people get hypnotized. They see green candles and tell themselves the danger passed. But a rebound after forced selling is not proof the system is healthy. It's proof the system finished eating. And if conditions tighten again, dollar spikes, yields jump, margin tightens further, that same loop can restart with a new set of victims who thought they were safe because they survived Act 1. So let me ask you this, and be honest with yourself. You ever stop and think whether you're holding gold or holding a margin equation with a gold sticker on it? Because there are two worlds here, physical metal and paper metal. One world stresses your emotions. The other world can delete your position before your brain catches up. In the next stretch, I am going to lay out the three pipes behind the collapse and bounce how USD and Fed expectations feed the move, how the margin trap accelerates it, and why silver can take painfully long to recover if you get caught on the wrong side of the whiplash. And then I'll give you a simple checklist to tell whether the pressure is leaking out or building toward a second hit. But first, you need to decide which world you're actually playing in, because the risk isn't just down, the risk is forced, and those are not the same thing. Let us kill the most stubborn myth first. A safe haven can absolutely fall like a rock. Safe is a long game label, not a promise about tomorrow morning. In the short run, gold trades like a non-yielding asset that competes with the dollar and interest rates. When the dollar hardens and real yields jump, gold doesn't get a magical exemption stamp. It gets repriced like everything else quietly at first, then all at once. Now zoom in on what lit the fuse this time, because it wasn't only fear or headlines. The market had been leaning one way, heavy, crowded, confident. Then expectations around the Fed shifted fast enough to make the dollar feel like the only clean shirt in the room. That is when the cash now trade starts beating the store of value trade. People don't wake up and suddenly hate gold. They wake up and suddenly need dollars. And when that happens, even the thing you bought to avoid panic becomes the thing you sell because of panic. Try to think about this. If you're holding an asset that doesn't pay you a yield, what happens the moment the world decides yield is back in charge? The discount rate changes, the opportunity cost changes, and the crowd has to reprice reality. Gold can still be a shelter, but the shelter has a rent, and that rent is set by rates. When the rent spikes, the weak tenants leave first, not because they want to, because they can't afford to stay, and then you get the second lever, the one that doesn't care about your beliefs. Leverage, futures, and margin positions turn, I think, into I must. That's the hidden brutality of paper markets. Physical gold can scare you, frustrate you, make you second guess. Paper gold can force your hand. The system doesn't ask if you're right. It asks if your collateral meets the new math. This is the dead weight detail people skip, and it's exactly where the story turns. Margin requirements went up gold to about 8% from about 6%, and silver to about 15% from about 11% for non-heightened risk profiles, with higher tiers pushed up too. That sounds like a small tweak until you translate it into behavior. More collateral per contract means less oxygen in your account, instantly. In a volatile tape, less oxygen is the difference between I can ride this out and I am being liquidated into the floor. Here's the cold mechanism, and it's why whiplash days feel haunted. Price drops. Your equity drops. Your broker demands more margin. You wire cash or you cut risk. If you don't wire cash, the system cuts risk for you. Forced selling pushes price down again, which triggers more calls, which triggers more selling. It's not a debate. It's a feedback loop. The market becomes a machine that turns volatility into liquidation. 2 sentences, and they're the whole horror movie. The numbers don't just move. The rules move too. When rules tighten during a drop, you're not watching a normal sell-off, you're watching the floor tilt. Try to think about this. How many traders lost without ever making a decision? They didn't panic sell. They got removed, and that's why so many people swear the move looked irrational. It wasn't irrational, it was mechanical. A margin event is a social purge disguised as a price chart. Okay, deep breath. This is the moment to slow down for a second, because if you miss this, you miss everything. In a crisis, people imagine the market as a crowd, but the market is also plumbing. Valves open, valves close, pressure builds where you can't see it, and when a pipe bursts, the first thing to flood is whatever was most leveraged. Alright, back to speed, because the rebound is where the trap resets. A margin-driven sell-off often comes. Into acts. Act 1 is elimination. The weakest hands are forced out until the selling is exhausted. Act 2 is the snapback. Once the forced sellers are gone, price can rebound violently because there's nobody left dumping at any price. Short stake profits. Dip buyers step in. Algorithms flip from sell weakness to by mean reversion. And suddenly the chart looks like a miracle, but the rebound can lie to you. A bounce doesn't prove stability. It proves the liquidation wave temporarily ran out of victims. The system can look calm right after it's done something violent. The way a room goes quiet after a door slams. That quiet is not safety. That quiet is the absence of forced sellers until the next trigger creates a new wave. This is where silver gets especially dangerous. And I want you to hear it without drama. Silver is thinner, more jumpy, more prone to air pockets. When it drops, it can overshoot simply because the market structure can't absorb the flow, and after a violent drop, silver can rebound hard then chop people to pieces for months. The whiplash isn't just a one-day event. It can be a regime where the market punishes impatience. That's why silver with turbo is a seductive phrase. Turbo is fun on the way up. Turbo is brutal on the way down. So let's get practical, because this is the fork in the road. If you hold physical metal, your risk is mostly emotional and logistical. Spreads widen, premiums behave weirdly, and you're tempted to do something dumb because the screen is screaming at you. If you hold paper positions with leverage, your risk is existential. You can be right on direction and still die on timing. I've seen it too. Many times to romanticize it, the market doesn't kill your thesis. It kills your buffer. I'm going to give you 3 blunt self-checks, and I want you to answer them like an adult, not like a gambler. Are you using leverage, even a little? If the market gaps another 10-20 in 1 or 2 sessions, can you survive without changing anything? And if margin gets raised again, do you have a plan that doesn't involve praying for a bounce? If any of those answers make you squirm, that's not shame, that's information. Here is the last reveal before we move into the forward-looking part. The next 7 to 30 days usually aren't about direction, they're about volatility. After a purge, the market either stabilizes into a messy range, or it sets up a second hit that targets the people who think they were safe because they made it through. And the difference between those two paths often shows up in a handful of signals hiding in plain sight: dollar behavior, rate behavior, volatility compression, flow, and whether the narrative changes from rebound to forced selling. So in the next segment, I'm going to map 3 scenarios the market tends to follow after a margin shock, and then I'll give you a 7-point checklist you can use like a dashboard. Not predictions, pressure gauges. Because if you can read the pressure, you don't have to guess the explosion. So where does this go next? 3 paths, and each one has a different tell you can actually watch in real time. Path 1 is the calmest. The market stabilizes after the deleveraging. That means the weakest hands already got ejected, the forced selling dries up, and price starts moving like a normal asset again, messy, but not violent. You'll still see swings. But they feel like waves, not car crashes. In this path, gold and silver can grind sideways in a wide range while everyone rebuilds positions slowly. And the weird part is this. A sideways range can be the most bullish-looking thing after a margin event, because it means the system is absorbing shock instead of amplifying it. Path 2 is the one that ruins people twice. The second shock. It usually comes when everyone relaxes and starts saying the bottom is in, and then one more push hits the same pressure points: dollar up, yields up, margin tighter, liquidity thinner. Try to think about this. If you survive the first flush by luck, what happens when you rebuild your position right before the second flush? That's why I keep saying the enemy isn't the red candle. The enemy is the moment the platform decides you don't get to vote anymore, and the second shock doesn't have to be as big as the first, it just has to arrive when confidence is back. Path 3 is the slow knife, a tug-of-war driven by policy expectations and headlines. Not a clean uptrend, not a clean crash, just a market that whips around every time traders reprice the Fed, inflation, growth, or geopolitical risk. It's exhausting because the story changes faster than the chart. One day it's safe haven, the next day it's higher for longer, then it's rate cuts, then it's strong dollar. The real tell here is narrative drift. If the story keeps flipping, volatility stays sticky, and sticky volatility keeps margin pressure alive. That is how you get chopped even if you rewrite in the long run. Now I promised you a checklist, so I am going to give you 7 signals I am watching like a hawk, because these 7 will tell you if the pressure cooker is cooling or if it's quietly heating back up. First, watch for any additional margin changes from the exchange or your broker, because that's a direct lever on how many players can stay in the game. Second, watch intraday range. Are the daily swings shrinking, or are they still expanding like the market is breathing through a paper bag? Third, watch the dollar. If it starts making higher highs again, metals will feel that gravity immediately. Fourth, watch long-end yields. If they're snapping around, it means the real yield story is still unstable, and gold hates unstable real yields more than it hates bad news. Fifth, watch flow, not opinions, especially ETF flows. In and out of precious metals, because flows tell you whether the rebound is real accumulation or just short covering theater. Sixth, watch silver's behavior relative to gold. Silver is the high beta cousin. And after a big break, it can spend a long time proving it is not just bouncing off the floor. Try to think about this. If silver can drop harder on the way down, why would it magically become safe on the way up? Seventh, watch the language in headlines when media stops saying rebound and starts saying forced liquidation. The crowd's mood shifts from greed back to risk control. That shift alone can change what traders do with leverage, even before price moves. Okay, pause with me for 10 seconds, because this part matters more than the chart. If you're holding anything leveraged, your biggest risk isn't being wrong, it's being early. The market can stay irrational longer than your margin buffer can stay alive. That's not a motivational quote. It's plumbing, and once you see it as plumbing, you stop taking it personally and start managing it like an engineer. Here is the part people hate hearing. Some of the bounce you just saw is mechanical, not emotional. When forced sellers finish dumping, the air pocket underneath price disappears, and price snaps back like a rubber band. Shorts cover because the move got too extended, and dip buyers rush in because the candle looks like a bargain. That's not necessarily bull market resumed. It's the market exhaling after being strangled. The danger is confusing that exhale with safety, because safety shows up later in the form of calmer ranges, thinner spikes, and fewer sudden liquidations. And I'm not saying every margin increase is some villain plot either. There's a boring, legitimate explanation. Exchanges raise performance bonds when volatility spikes because they re-protecting the clearing system from default risk. That's the job. The uncomfortable truth is that protecting the system and crushing small accounts can happen at the same time, even if nobody intended the second. Outcome. Markets are messy like that. One action can be rational for stability and brutal for individuals. That's why I keep everything on mechanisms instead of heroes and villains. One more educational note, and I'll keep it short. If you trade leveraged products, read your broker's margin schedule, liquidation policy, and any exchange notices because the rules can change fast and ignorance doesn't get refunded. So what's the takeaway you can actually use? If you're holding physical, your main battle is psychological volatility, spreads, premiums, and patience. If you're holding paper with leverage, your battle is arithmetic, buffer size, maintenance thresholds, and the speed at which your broker can close you. Try to think about this. Two people can have the same bullish thesis and completely different outcomes, just because one has enough cash to survive 48 hours. In a whiplash market, the winner isn't the person who predicts the direction. It's the person who stays in the arena long enough for the direction to matter. Now we close. The loop from the beginning. The scary headline wasn't gold down or silver down. The scary headline was margin requirement increased, because that sentence turns the market from a debate into a forced vote. Prices can fall and recover. Forced selling is what turns a fall into a stampede, and the stampede is what makes the rebound feel like a miracle right up until the next shove. If you want part 2, I'll do it, but only if you tell me you actually want it. Comment the word margin if you want a clean breakdown of how margin calls cascade, how to build a buffer, and how to avoid getting liquidated even when your thesis is right. And if you got value out of this, hit like and subscribe, not because it helps the algorithm, but because it tells me you want more of this war room style analysis when markets get ugly. Also drop one thing you're watching this week: dollar, yields, margin updates, ETF flows, because your comments are basically real-time intel for everyone else here.